please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. The two-day JPMorgan India Investor Summit is currently underway in Delhi. Let's go across to Rupee. She has with her Filippo Gori, the head of markets and investor services at JPMorgan Asia Pacific. Rupee, over to you.
Thank you for that. Yes, Filippo is right here with us, and we've only just gotten started. Things are warming up at the JPMorgan India Investor Summit. Now, Filippo, of course, looks at different asset classes. He looks at the entire emerging markets complex, the Asia Pac complex as well. So there are lots of questions, Filippo, that we have for you. And right now, we're speaking at a very interesting time when emerging markets are not quite the flavor. We are seeing these outflows happen. We're seeing the currencies get roiled. And India is also caught up in the storm to quite an extent. First of all, your view on what trade wars are sort of doing to the emerging market complex as a whole. Is this a passing, transient phenomena, or could this potentially spiral up into something more serious?
Look, my feeling on the trade war is it's a lose-lose situation for both countries involved. Whether it's going to spiral out of control and therefore create a sort of a bigger problem for the overall emerging markets asset class, I think it's too early to call. I still have an optimist view that the trade war will be somehow resolved. If you look at overnight, some of the equity indices post the announcement of the retaliatory measures from by China, they haven't really moved that much. So I think there is still a degree of optimism underlying the fact that the trade war should not have an impact. And if anything, India should benefit, could be benefiting from a trade war, because it should remain to a certain extent immune from that pain. I think EM as an asset class overall is feeling the hit a little bit of the rising rate scenario in the US, and the current account deficit countries are suffering because of that.
Yeah. So just a follow-up question on this. The sort of US rate hikes that are sort of built in, we're talking about 2 more at least this year.
Yes, that's what we expect.
So does this mean that the dollar keeps tightening from here on, and therefore, generally speaking, we're going to get more weakness in emerging market currencies?
Again, I think it's too early to call. Definitely, while 2017 was the year where you had a global growth coming from all the countries, this year I would say is more of the year of the decoupling. The US economy is still going on very strongly, and we expect further hikes this year. Europe and my own country is having different sort of problems, and in EM you start seeing kind of a 2-tier environment where the current account deficit countries are suffering, while those who have a surplus are probably faring better than the others. Whether overall it's the end of the capitulation of the EM trade, I think it's just too early to call it.
Filippo, hi, good morning. Prashant here from the studios in Mumbai. So what happens next? I mean, you know, when we ask in this trade war thing, when we say, when the question gets asked, we say, well, we get an answer generally to the effect that we'll have to watch the trade war situation closely, how it unfolds. But what really is there an end game in sight when we say, you know, let trade war subside? I mean, China is not going to say that, well, walk on all over us, right? I mean, they're going to retaliate in equal measure. So then what are we really looking at when we say that we're going to watch this closely? Because we hear that a lot. What's your sense?
My sense is that ultimately the two parties need to go to the table and find a solution. I think in previous conversations there are some basic points for an agreement between the two parties, and there are also some red lines that either one don't want to be crossed. What we need to watch out for, I think the first phase is kind of finished. We are in the second phase. A third phase could be whether the CNY depreciates from here substantially, which could be a way that China could use to absorb some of the tariffs that the US is using. Frankly, we don't believe that, that the further depreciation of the CNY may be up over 5% is on the cards, because China just recently announced some measures aimed at strengthening the currency. They announced them, if I'm correct, around August 20th. So it would look strange that now, not even a month later, they removed them. So I think the two parties need to go back to the table and try to find a negotiated solution. And bear in mind that the impact really of the trade war is not going to be felt this year, but more next year. So there is still room to find an agreement.
Sure. So, Filippo, follow-up question to that then. India has only corrected right now about 3.5%, 4%. That's it.
In the month of August.
Exactly. Whereas the other emerging market, the rest of the basket has corrected a lot more already. Are we looking at a bigger correction ahead here in terms of valuations, currency, the entire play?
Let's talk about currency first. Our view is that the currency will remain around 72, probably in up to June of next year. I mean, we feel that there are probably two hikes coming from RBI, one in October, one in December, and possibly we think that the government will defend the currency strongly even inter-meetings. The economic fundamentals of India remains super strong. I mean, the last quarter was the best quarter that India's had, with an outstanding growth of 8.2, 8.3%. It was the best quarter of the past 9 quarters, and our forecast for next year is still that India will grow at a 7.3% GDP growth, which would put India as the fastest growing economy in the world. So the economic fundamentals, the demographics, the tech sector, the healthcare sector are still doing superbly well in the country. The country has a current account deficit. 3% of GDP is being watched by foreign investors. Next year is an election year, and therefore investors will be looking at carefully for fiscal profligacy, and what investors will want to see is some sort of fiscal orthodoxy. I mean, a certain way of behavior by the government that will protect the currency, and therefore I think we are not looking at a doomsday scenario.
Filippo, afternoon. This is Rima here from the studio, in the Bombay studio. Overnight, we saw the US 10-year yields cross the 3% mark. How much of a risk are outflows going to be for the emerging markets, and can that be a pain point going ahead? The MSCI emerging markets have already corrected 10% on a year-to-date basis. On the back of these developments, do you see more pain ahead?
Look, the fact that with dollar rates going higher in the US, we would have seen an outflow from some of the EM trades, I think it was natural. Again, I don't think it's a capitulation, and I was just looking at the outflows just before coming here on the studio, and yes, there have been some. They have particularly been concentrated on those in bonds and on those countries which had a substantial current account deficit. So we saw the Turkey, the South Africa, the Argentina, and the Brazil. Everywhere else, if it has happened, it's limited, and some countries are actually enjoying inflows yet. So again, I think it's too early to call it a capitulation trade for the EM asset class as an overall. Clearly, there are some headwinds coming.
So
got 42 odd points on the Nifty, so 11,320 is where we stand. So it's steady, but it's not building on so far. Rima, maybe things will pick up later in the day.
All right, let's invite our next guest then. Deepak Shenoy, the founder of CapitalMind.in, joins us on the show now. Deepak, good morning. The talking point today is the big cut seen in HDFC AMC as well as Reliance Nippon. Both those stocks should come up on the screen. HDFC AMC is down about 6%, while Reliance Nippon Asset Management is down about 9%. Your thoughts, how much of an impact will the SEBI cutting the total expense ratio have on these two companies? And is it priced in with the cuts that we're already seeing today?
Yeah, I think it's very interesting from a point of view of valuation. So Reliance is probably lower valued in those terms compared to HDFC. But what's really happened, Rima, is that the whole structure of the industry is changing. We're getting a regulator who's obviously a lot more concerned that the scale dynamics have not played out on expense ratios. In contrast, in the last 3 months, HDFC AMC itself has raised total expense ratios for direct plans by 5 to 10 basis points in 3 different announcements each. So we've seen an increase in total expense ratio in spite of their AUM going up. So in that context, I think the regulator's taken a hard and perhaps a very investor-friendly stance of saying that I'm going to limit total expense ratios. To give you an example of one of the funds that they have called HDFC Balanced Advantage, there is a TER currently of 1.76% plus GST. So effectively 2% for a fund that has nearly 40,000 crores in assets as of August 31st. If you reduce those, if you consider a 2% fee on a 40,000 crore asset base, you're talking nearly 800 crores of effective fees for investors, out of which, we will say bring it down to 1.4 or 1.5% according to the new TER. HDFC AMC will suffer about a 200 crore loss just on that one fund. There are a number of others as well. So there is going to be a drastic reduction in total income. There may be some of this passed on to the distributors themselves, because the distributors will now get no upfront commissions and also get a lower trail commission. So in all probability, they will be able to pass on some of these costs on to distributors. Even then, we're looking at a 15-20% impact in the immediate future compared to previous TERs that they've announced. So the bet, if it has to be on the growth of the asset management industry in the longer term, not on shorter term income, and that in general has translated to any kind of practice that AMCs have done in the past,
right,
to gather more fees. For instance, in March, sorry.
No, absolutely great points there, and very well explained, Deepak. Morning, Prashant here. No, my question was whether even the long-term prospects suffer at some level, because there is less incentive for distributors to push these products.
Yes, I mean, there's competition risk really, because insurance offers a substantially higher percentage return. And customers are gullible, they can be sold anything. Some of them have become smart enough to understand that insurance is probably not a great place to invest, but for the most part that becomes a problem, because you've got competitors paying you 5-10% commissions, whereas you're actually reducing your commissions as a mutual fund. Having said that, there's still some practices that they've done. For instance, they used to have closed-ended funds, 3 years. So in 3 years, I'll charge you 2% per year, so 6%. So I'll pay a commission of 4% upfront. I'll keep 2% for myself as an AMC, and I will do a 3-year fund right now. A lot of mutual funds prefer to take that route. In fact, confusing it sometimes with other debt funds, which are usually done with these closed-ended FMP kind of process. In March this year, we saw one fund house do that with an equity fund. These kind of mechanisms will stop, because the total expense ratio that you can charge is 1.25% limited on equity funds if they are closed-ended. So they will not be able to give those massive commissions and will not be able to take them upfront. Plus now commissions have to come from the fund, not from the AMC, which means the AMC's books will be monitored to see, are you making any payments back-ended to the distributors. Biggest impact is on the distributors itself, like banks. The biggest distributors are banks. So we should actually not be worried so much about the AMC, but also about an HDFC bank and an ICICI bank earning a lot lesser commissions down the road.
Okay, and on the subject of banks, what about Bank of Baroda? It lost a significant amount of its market share yesterday after that big bank merger was announced. At current levels of 117, how does it look?
Yeah, it's an interesting merger. I think it's actually quite positive in the long run if they're able to solve the problem of employees. They're geographically reasonably well distributed. So you've got representation of the east, south, and north. or northwest. But in general, we feel that the idea over here should be to look at the triggers that will cause you to understand better about the investment. So one of the things that happens here is we have a merger. That together, all three banks together probably have a market cap of about 42,000 crores if the merger ratios were as of yesterday or of the day before. So with the 42,000 crore market cap, you'll have a book value of approximately 60,000 crores, large amount of NPAs. If you wrote off 75% of the net NPAs, current net NPAs, you would have a book value of 36,000 crores. Basically 24,000 crores will vanish in losses. But 42,000 market cap for about a 36,000 crore book is not a bad valuation for a pan-India bank. Plus they'll be able to raise capital and perhaps growth will cover some of the future NPAs as well. So the overall structure looks good. What remains to be seen is expense ratio, the conversion ratios. So what are we getting, what are Bank of Baroda shareholders getting? Are Dena Bank shareholders going to see a lower conversion ratio to the new bank? And secondly, what are they going to do with all the employees? Are they going to offer them VRS? Is it a one-time hit that they're going to take rather than let the process stretch on for a while? I'm sure the bank employees know this and some of them will be quite willing to take a VRS package. So it will be a one-time cost. Maybe the government will bear that. So thirdly, what are they going to do about growth going forward and scale? So these are the triggers that will come in the next few months. I think watch for each of these triggers, and as more clarity emerges, it is not an expensive proposition at all. We just have to make sure that these banks are actually working hard to clean it up and to try and grow. Dena can't grow. Vijay has done a great job. Bank of Baroda is slowly getting back up on its feet. So if the combined entity can actually do a better job of growth and cleaning up their books, I think this is a good opportunity. Having said that, wait for the triggers. Too much unclear right now to just say buy now, but this is the thesis.
So as I said, 40 on the Nifty, but let's just spend some time looking at stocks. And let me start with JSW Steel. Ashwini highlighted that as a buy. It has taken out its recent trend high, 422. JSPL will come up next, 3% higher. That's about 237. Muthoot Finance is up 6%, 470, and I'm only highlighting stocks with large volumes. Steel Authority of India, so that's the third steel stock, is up 3.5%. DCM Shriram is up about 6%, again large volumes in it. There was JK Paper, which is again buzzing, 7% on it. Global Spirits has come back quite a bit. I think it's been a good week so far, 9% on Global Spirits. Good volumes there. International Paper, so yeah, JK, International, West Coast, paper stocks generally are Star Paper, between 5 and 7% gains on these paper stocks. There's Orient Paper as well, which I can see, which is buzzing at this point in time. So that's essentially what's happening on the upside. On the downside, there's the HDFC AMC name, which is down 7. We discussed that with Deepak Shenoy earlier. Reliance Capital is down 3%. Jubilant Food is down about 3.5%. That's HDFC AMC, Reliance Capital, and Jubilant Food. Reliance Infrastructure is down about 4.5%. There's Jet Airways, which is down 4%. Actually, that's about it. Reliance Nippon is also down, I think 9% or so right now.
And even some of the other companies like Edelweiss Financial or Aditya Birla, which also have mutual funds, these stocks too are under pressure.
And they are big distributors as well.
Yes.
So that's the other hit which comes through. So that's the broad sort of gainers and losers spectrum at this point, but we'll keep getting you more. Let's get back to the macro story, which of course has been dominated by what's happening with the rupee. It's recovered a tad bit this morning. It hit a record low of 72.97 yesterday. We spoke with Jahangir Aziz on the sidelines of the JPMorgan conference, and these are his views on where the rupee goes next and, of course, what the RBI will do in its October policy.
There are much simpler solutions to these problems. There is much simpler explanation to where we are, why we are. But if we do not want to go with these simpler solutions and simpler explanations, instead we want to get tangled in the weeds with exports, imports, oil prices, we are going to come up with these kinds of very tangled solutions and tangled views. There is a very simple this thing, and there is very little controversy about it. There are two reasons as to why the rupee is under pressure, like any other current account deficit. The current account deficit is rising, and global financial conditions have actually tightened through April till July. In August was very different. Then in August, emerging market risk was being reassessed. If you've made up your mind, I don't know whether RBI has made up his mind or not, but suppose they have decided that they're going to hike in October 5th or 6th, whenever the policy date is, then it's much better to do that rate hike now, in fact last week, in fact the week before that, than delay it till October. The effectiveness of that rate hike goes away, diminishes, the longer that is delayed. And I don't see these artificial things about policy review October 5th, therefore I can't hike before October 5th. Those are just, artificial restrictions. So if you're, I'm not so much worried about how many rate hikes as I'm worried about how quickly the rate hikes come in. Because the more you delay it, the larger the rate hikes always end up being.